In a bold move that few countries have dared to attempt, Burkina Faso has taken back control of its gold mining industry not just in theory, but in practice. The government seized full ownership of 5 major gold mines previously operated by foreign, mostly Canadian, companies. These weren't abandoned or dormant sites. They were thriving, high-output mining operations that had been running for over a decade. Now, thanks to a new state-owned enterprise called SOPIME, every ounce of gold that's extracted from Burkinabe soil is staying in the country. And just like that, Canada was quietly pushed out. This shift didn't come out of nowhere. For months, signs pointed to a brewing transformation. In August 2024, a significant revision of the National Mining Code laid the foundation for what was coming. Soon after, a fully Burkinabe-run mining corporation was launched. Still, few anticipated such a rapid and sweeping action. Until recently, Canada was a dominant player in West Africa's mining sector. The biggest gold operations often had their corporate headquarters and executive teams stationed in Toronto. But the winds have changed. The Burkinabe leadership has torn up the old playbook, one where African nations extracted resources for foreign benefit and replaced it with a new model focused on self-reliance, national ownership, and equitable wealth distribution. Burkina Faso ranks as Africa's 4th largest gold producer, pulling more than 57 tons of gold from the earth in 2023 alone, worth over $3 billion by global market estimates. But historically, very little of that wealth stayed in the country. Most of it was exported to financial hubs abroad, leaving Burkina Faso among the world's poorest nations despite its mineral riches. That contradiction became the fuel behind Captain Ibrahim Traoré's reform agenda. From the moment he assumed power, he asked the hard questions. Why is a country sitting on billions in gold struggling to fund basic services like roads, hospitals, and schools? Why do mining CEOs in Canada reap greater benefits than the people who live above the mines? The answers sparked one of the most dramatic shifts in African resource management in recent memory. This wasn't a populist uprising or a protest movement. It was quiet, calculated economic warfare. Throughout early 2024, the Burkinabe government began tightening regulations, increasing oversight, and asserting national control over the mining industry. Foreign companies suddenly faced mounting bureaucratic hurdles. License renewals were delayed, and stringent environmental audits were launched. Behind the scenes, pressure was mounting for foreign firms to either hand over their stakes or walk away. The real turning point came in August 2024, when the government updated its mining code. Under the revised law, the state was guaranteed a 10% share in all new mining ventures, with the option to increase ownership to as high as 70% in strategic cases. This wasn't just a policy update, it was a declaration. The target was clear: foreign-run large-scale gold mining operations. Canadian companies like Semifo, Endeavour Mining, and Fortuna Silver Mines soon found themselves sidelined. Some didn't even contest the changes. Instead of engaging in drawn-out legal battles, they shifted their investments elsewhere. Fortuna, for instance, quietly pivoted its focus to Guinea and issued a vague public statement that noticeably omitted Burkina Faso's name. These firms understood that challenging the Burkinabe government's decisions would be costly, not just financially, but politically as well. Many of these companies still operate in other African nations and didn't want to jeopardize future opportunities across the continent. Most crucially, Burkina Faso refused to compromise. There were no negotiations, no half measures. Foreign investment would still be welcomed, but only under a new framework, where the Burkinabe state calls the shots. This approach marked a significant departure from the previous era of extraction, where foreign stakeholders reaped profits while the host country received crumbs. Meanwhile, Canada remained largely silent, with its mining companies facing years of scrutiny over environmental damage, labor issues, and exploitative contracts. In Africa, any aggressive defense of their business interests in Burkina Faso could have sparked a global backlash. Silence became the safer path. And so, without a public fight or dramatic headlines, Canada exited Burkina Faso's mining scene not with a bang, but with the soft thud of closing office doors and expiring contracts. But the exit of foreign firms didn't leave behind abandoned mines. On the contrary, fully operational mining sites, complete with trained workers and existing infrastructure, remained ready for use. Instead of auctioning them off to new foreign investors, the government launched SOPIME, short for Société de Patrimoine Minier du Burkina, a new national mining corporation, built not just to hold assets, but to run a modern, fully functional gold mining operation. Unlike many state-run experiments in Africa's past, SOPIME was not a symbolic shell. It absorbed local experts, engineers, geologists, operators who had previously worked under Canadian firms, but were already doing the day-to-day tasks on the ground. For the first time, these operations were being run from Ouagadougou, not Toronto. The goal wasn't just to maintain production, but to grow it on Burkinabe terms. SOPIME also brought in regional logistics partners and local companies for security, maintenance, and transportation. It offered contracts to Burkinabe businesses that had previously been excluded from the mining economy, and instead of refining gold abroad, the company initiated plans for a regional gold refining hub, working with neighbors like Mali and Niger to add value within Africa. Though young, SOPIME is already producing results. In 2024, the state collected over 8 tons of gold, and in just the first quarter of 2025, more than 11 tons, a haul worth approximately $780 million at current market prices. That revenue is now being directed toward public services, infrastructure, and national development, not into the bank accounts of shareholders in Montreal or London. This transformation is not without risks. Running a mining empire is expensive and complex. But for Burkina Faso, the decision wasn't about ease, it was about sovereignty and dignity. By taking back control of its most valuable natural resource, the country sent a clear message: this land belongs to its people, and so does its gold. What we're witnessing is not just a resource shift, it's a historic economic revolution, quietly executed, yet loud in its consequences. For the first time in generations, Burkina Faso's gold is staying home. In under a year, Burkina Faso achieved what many thought impossible. It dismantled a network of foreign mining giants, kept gold production uninterrupted, and re-engineered the entire gold value chain within its own borders. But this wasn't just about replacing Canadian mining firms. It was a complete rejection of economic dependency, built deliberately, mine by mine, and run by the same local experts who were once taking orders from foreign corporations. Today, Burkina Faso not only owns its gold industry, it controls it entirely. And it's not standing alone. A regional shift is unfolding. Burkina Faso, Mali, and Niger are moving in lockstep to reclaim control over their own resources. These former colonies are no longer content to be raw material suppliers for the global north. They are rising as resource powers in their own right, coordinating strategies and rewriting the rules of African extraction. This alliance isn't just symbolic, it's operational. Together, they control some of the most vital minerals on Earth: Mali's gold, Niger's uranium, and Burkina Faso's vast mineral deposits. Alone, they could be pressured or picked off, but united, they form a powerful bloc that the world can no longer ignore. Burkina Faso's mining revolution has shattered long-held myths, chief among them the idea that African nations lack the expertise to run complex mining operations. For decades, this myth allowed foreign corporations to dominate Africa's resources with minimal transfer of skills or technology. But Burkina Faso just proved that was never true. The same engineers, geologists, and technicians who once worked under Canadian companies are now running the show for their own people. The only thing missing before was control. Perhaps the most innovative part of Burkina Faso's new model is its inclusion of small-scale miners, who were previously treated as obstacles by multinational firms. Instead of pushing them aside, the government brought them into the fold, offering regulation, support, and pathways to integrate into the national mining strategy. This isn't just about extraction anymore, it's about building a mining economy that works from the ground up, not just from the boardrooms down. But this revolution goes beyond gold. Burkina Faso is now focused on value addition, not just digging up resources, but processing them at home. The country is constructing its first gold refinery, marking a move from exporting raw ore to producing high-value, refined gold. This transition isn't just symbolic, it's transformative. Refined gold fetches higher prices, creates skilled jobs, and builds entire support industries from chemical processing and logistics to equipment manufacture. In quality control, Burkina Faso is no longer playing the role of supplier, it's becoming an industrial power. This model could change Africa forever. For the first time in modern history, African nations are keeping the wealth from their own resources. What once flowed to stockholders in Toronto or investment firms in London is now being used to build roads, fund schools, support hospitals, and invest in local industries. The same gold deposits that once financed Western pensions are now financing African futures. And for international mining corporations, this shift represents a serious challenge. The traditional supply chains run from offices in Toronto, London, and Sydney are now being reshaped by leaders in Ouagadougou, Bamako, and Niamey. If global companies want access to these critical resources, they now need to negotiate with African governments on equal footing. But the transformation runs even deeper. The emergence of state-led mining companies is catalyzing the creation of domestic financial systems, local capital markets, and regional trade partnerships, no longer dependent on foreign loans or foreign currency. Burkina Faso and its partners are developing the financial muscles to sustain their own projects. This new financial independence is just as critical as the operational one. It means decisions can be made in Africa, for Africa, without having to ask for permission from abroad. And despite all the skepticism, warnings about inefficiency, fears of mismanagement, the strategy is working. State-run mining operations are not only sustaining production levels, but in some cases, increasing them. This isn't a repeat of past nationalization failures. It's the birth of a new model for African resource sovereignty, one that's already showing results and gaining momentum across the continent. For decades, the standard playbook was the same: lure foreign investors with tax breaks, offer legal guarantees, and hope someone would extract the wealth beneath the soil. But Burkina Faso is tearing up that script. It's building a new model, one that provides actual leverage, not dependency. A model that empowers countries to negotiate from strength, not desperation. This revolution is spreading. Other African nations are watching closely. Some will copy it exactly. Others will tailor it to their unique needs. But one thing is clear: the age of unquestioned foreign dominance in African mining is ending. Companies that relied on old, extractive models maximizing profit while offering little to the host nations are facing an uncomfortable truth. The continent is waking up, and the rules have changed. Canadian firms, once confident in their iron grip on African mining rights, are realizing those rights were never permanent. The guarantees they once enjoyed are crumbling, and those unwilling to form equitable partnerships are being shown the door. The companies that will thrive in this new era will be those that offer true collaboration, real technology transfer, and shared benefits. The ones who cling to the past, they're already being left behind. Africa is done being mined. Now it's time to build, and Burkina Faso just lit the path forward.